that gives us a sense of background. Let's now talk about what's happening now in the economy. I want to start with the banking and financial sector first. A year ago, a new home buyer might have been quoted a variable rate mortgage of prime less 0.5%. Today, that same home buyer walking into his or her bank would be quoted a variable mortgage rate of prime plus 1%.
Take it.
So Carlos Leitão, what is happening right now in the credit markets, and why is it so much more expensive to borrow now?
Okay. Again, it's a global issue. Canadian banks are affected less than other banks, but we are affected. We rely heavily on our retail deposit network, unlike other banks, unlike the Wall Street bank, unlike the British banks and others. But we do rely to some extent on the wholesale market. We do borrow as well as other banks do. Roughly depends from bank to bank, but let's say about 20% of the liquidity of the Canadian banks come from the wholesale market, issuing of bonds and whatnot. And it's that 20% that now is costing us a whole lot more. So even though we have a stable and steady supply of cheap funds from the retail network, some banks more than others, but we have that, we still need to borrow, and that costs us a lot more, so that our average cost of funds has really increased a lot. And then we are in the business of making money, we're not in the business of losing money, sorry, we're not a charity, so we pass along those higher costs in terms of higher interest rates.
Let me interrupt. The Bank of Canada, though, since December of last year, has reduced the prime rate 225 basis points. Why haven't we seen that? Why isn't that reflected in our lending costs?
We have passed it on to some extent to down to the client, because as I say, the cost of borrowing must reflect the cost of funds to the institutions. If we start to lend below cost, we end up like GM, and we don't want to be. We don't want to do that. And again, the formula is not a simple one. What is exactly our average cost of funds? There's a lot of discussion even within banks on how you calculate that exactly. But the fact is, the cost of it costs us more to acquire funds these days. And also because of all those problems, there's even though you may not believe it, but there's a lot of competition in the Canadian banking system. These days, competition for deposits. Everybody wants deposits. So we unfortunately have to pay a little bit more to keep our deposits. So the cost of funds is indeed going up, and so we are affected indirectly by all of this, volatility in financial markets. Because if you try to issue a bond these days and you are a Canadian bank, you're going to pay a lot more than you did only 2 years ago.
Let's move. When could we expect borrowing rates to fall? When can we expect sort of confidence to be completely restored in the financial system? Looking a year or two ahead, what can we expect from our banks?
The policy rate to get the overnight rate, maybe another 25 to 75 basis points, and then that's about it. Then the question becomes, how will credit spreads evolve? And that will depend on the degree of confidence in the interbank lending market and whatnot. And so when will that return to normal? Once all of the bad assets have been written off by all the big banks, how long will that take? 6 months, a year? I don't know. Very honestly, I don't know. I'm still very, very worried now about the next leg of this whole thing, which is US consumer debt, credit card loans, car loans, student loans, because those things were also heavily securitized, so sold off. So I don't think we've seen the worst yet, unfortunately, of the credit issue. So spreads will remain very wide, and so interest rates to the ultimate consumer, even though the policy rate is way down, those interest rates will still remain not out of whack, but it's still expensive.
So yeah, I think the issue is when does the credit crisis end? In Canada, we've experienced credit crisis light, much milder version than certainly the US and Europe. But it really revolves on US house prices have to stop falling. Because if they keep falling, the value of the mortgage-backed securities keeps falling. Banks keep writing bigger write-downs and they pull back on the credit pipes. So When will that happen? Well, there's still a big overhang of unsold homes in the U.S. housing market. Almost 1 million or so homes sitting vacant, ready for sale. And until those are cleared out, it may take 6 months, maybe longer to do that, and only if demand revives will house prices stop falling. So I think for the next 6 months, it's going to be touch and go for the credit
We're not going to see
crisis.
better rates.